Thank you so much. Thank you for having me. In a way, this is a good follow-up because this is also a paper about using quantiles to estimate probability distributions. This is joint work with my co-authors, as you mentioned. Four of us work at the IMF, so the standard disclaimer applies. So let's get going. So as I think most of you may know, global debt levels are very elevated and are projected to keep increasing. They exceeded $100 trillion US in 2024, and debt to GDP is expected to exceed 100% of global GDP by 2030, led by the two largest economies in the world, the US and China, but also several European economies. So for example, in the EU, debt is projected to increase from 83% of GDP in 2025 to 87% by 2030. And just to pick a country, in France, it's expected to increase by 116% in 2025 to 129% by 2030. And this is before incorporating any of the recent world events. So why is high debt a problem? High debt is a problem because it reduces fiscal space, and that's in normal times, and we're already beginning to see the signs of that. But then in more extraordinary times, debt surprises have been shown to create lots of sovereign stress and detrimental macroeconomic outcomes. And we've seen this in advanced economies and in emerging market economies over and over again. So studying the risks around the debt outlook is therefore an essential exercise for researchers as well as policymakers. So in this paper, we develop a novel debt at risk, or DAR framework, to quantify the full distribution of risks around debt projections. And let me quickly walk you through the exercise, and I'll go into more details. So the approach builds on the growth at risk methodology that was already mentioned in Stephen's talk earlier today. And essentially, we have panel quantile regressions for a sample of 90 countries covering more than 90% of global debt. And we construct predicted quantiles of future debt to GDP at a forecast horizon of 1 to 5 years. And these quantile estimates, which are point estimates, are fitted to a skewed T distribution, which is standard in the literature. But a lot of our results are somewhat invariant to the use of this distribution as a fitting methodology. And then these densities conditional on multiple variables, this is one of the key innovations of our paper, are combined to a single distribution based on the individual factors' predictive power. So in the spirit of yesterday's talk by Professor Rossi, this is kind of a forecast then aggregate type exercise. So what are the advantages of this approach? I think there are a few. First, we go beyond the proximate drivers. So by that, I mean, if you think about debt, you can just decompose it in a simple equation and say it's the sum of today's debt, the interest rate growth differential, and the primary balance. And we go beyond these proximate drivers to consider underlying factors such as financial stress or political or policy uncertainty that could affect all drivers at once rather than one by one. We can also estimate these factors as asymmetric and nonlinear effects on the debt distribution. I'll explain what I mean by that. And then, of course, ultimately, we are able to quantify how high debt could rise in an extreme adverse but plausible economic scenario. And then finally, beyond just this quantification exercise, we can see if this is a meaningful metric by assessing the relationship between debt at risk and fiscal crises. A quick preview of the results. We find that several financial, political, and economic variables, so the non-economic variables also matter in that they shift the entire future debt distribution with stronger effects on the right tail. So in other words, there are asymmetric effects on upside debt risks relative to downside debt risks. Putting everything together, we find that global debt at risk is around 117% of GDP for 2027. So the latest year we use is 2024, so this is 3 years ahead, which is nearly 20 percentage points of GDP above the IMF's World Economic Outlook projections, and would bring global debt to a level not seen since World War II in terms of percent of GDP. We also find that debt at risk differs across countries and country income groups, so it's much higher in advanced economies, but is somewhat stabilized. In emerging markets, it's lower, but has risen. We can use this approach where we combine distributions to kind of mechanically look at what factors are driving debt risks for each group. And we find that economic and political conditions, political uncertainty are more important drivers of debt risk for emerging markets, whereas financial factors matter more for more advanced economies. And then beyond this kind of economic quantification, we find that debt at risk actually is a very robust variable in predicting fiscal crises or a future fiscal crisis, and actually outperforms other standard fiscal and macroeconomic variables. OK, so just a quick overview of the data. So we have an annual panel. So it's a country-by-year panel, because debt data for most countries is only available reliably at an annual frequency. And our interest is really to capture global debt risk, so we want to include as many countries as possible. The key variables that we consider are the following financial variables. We take the IMF's Financial Conditions Index, the Financial Stress Index developed by Davide and co-authors, and then sovereign spreads. And we tried a lot of other variables, such as yields, such as ratings changes, and the results really don't change much. On the political side, we take the World Uncertainty Index and also an index of social unrest. And then on the economic side, we take all the standard drivers of the debt equation that I talked about earlier, which is your starting point of debt, primary balance, growth, and inflation. And so we take all of these, and then we estimate quantiles. But we don't use a standard quantile regression, because with a panel, if you introduce a fixed effect in a quantile setup, you would create an incidental parameters problem. So how do we solve this? We solve this by estimating a location scale model a la Machado and Santos Silva 2019. And I'll explain the model, but it really is an innovation in itself, because it allows us to look very carefully at the mean as well as the kind of standard deviation effects of any variable on the debt distribution. So our specification, we have future debt on the left-hand side. We have country fixed effects. We have a vector of predictors, and we include the initial debt level, so DIT, in all specifications. And then the key parameters to really focus on are beta, which is the location parameter. So this parameter measures how the entire distribution shifts as a regressor moves. And then the scale parameter captures whether this shift differs across quantiles. So in other words, the scale parameter would tell you if there are asymmetries in this relationship between a predictor and the thing you're trying to predict. And the tauth quantile of future debt is then a linear combination of all of these metrics, as shown in equation 2, where Q tau is the inverse CDF of the error term evaluated at the tauth quantile. And the key part is that the quantile regression coefficient for any predictor that comes out of the location scale model is a linear combination of these beta and gamma terms. OK, so given that this is maybe somewhat of a non-standard model, let me explain let me build some intuition around these beta and gamma parameters. So the key part is that the effects of any conditioning variable on the future debt distribution depend on these parameters. So I present 3 cases. The first one is the one where you have kind of a standard OLS type effect. So gamma is 0, beta is positive. So if you have a change in an x variable or in a conditioning variable, then the entire distribution just shifts. In case 2, you have a situation where both beta and gamma are positive. So what does that do to the distribution? And this is taken from real examples in our data set. You shift the median, but you also shift the 95th percentile beyond the median. So you can see that the gap between the 2 dots is much larger than the gap between the 2 vertical lines. And then obviously the opposite happens in case C. OK, so we've done the step of estimating these quantile regressions. We do this one by one. So by one, I mean we put each conditioning variable on the right-hand side, and we get quantiles for each of the 8, predicted quantiles for each of the 8 variables. Now, how do you combine them? And so the next 2 steps that I'll describe go into this process of combining the quantiles from various models into a single density. So because our interests are really in the quantifying the upside and downside risks, we recenter the quantiles so that the median is matching the baseline debt projection of the IMF. But really, this shift is not huge at the global level. It's around 2% of GDP. And then we fit them to a skewed D distribution. Let me focus a little bit on the next step, which is another key innovation of the paper beyond this location scale model. So we pool densities using a weighted sum of the densities based on these individual predictors. So we have 8 individual predictors indexed by M, and then we pool them using these weights. And these weights sum to 1 and are picked to maximize the out-of-sample predictive accuracy of the combined distribution. And the way we compute the weights is we basically say, let's calculate probability scores So in an out-of-sample setting, and that's key, it's out-of-sample, we say, let's take the previous 20 periods and predict the full distribution, and then see where the realized debt outcome lands on that probability distribution, conditional for each variable. And then the variable that does best, say financial conditions do best, is the one that gets the highest weight. So in a way, we're combining distributions like you would with a multivariate regression, but in a way that looks at the full distribution rather than a point estimate. OK, so let me give you some of the results that we have. So one of the baseline results that we have is adverse financial and political developments are associated with higher debt at risk. So there's asymmetric effects. So the charts here will show the quantile regression coefficients, so the beta plus gamma q tau coefficients across various forecast horizons, which are on the x-axis. And the panels just show the different conditioning variables that we use. And so what we can see here is that financial and political variables are associated with asymmetrically higher debt risk. So the 95th percentile coefficient, the red bar, is larger than the median or the 5th percentile. And the strongest effects are at a 3-year horizon. So for example, in panel A, we can see that a 1 standard deviation increase in the financial conditions index, such as the one experienced in Spain in 2011, is associated with a 3% of GDP increase in the debt at risk, but the effect at the 5th percentile is smaller. And so the coefficients are also meaningful because at the global level, this upside risk is 20 percentage points of GDP, so this is 3% for a single standard deviation. And then we look at the economic factors, and here the results are comforting and kind of to be expected. So when we include them, we find that economic factors have persistent and, but this is the key part, asymmetric effects on the debt distribution. So in particular, if you look at higher initial debt levels, which is panel A, and then lower growth, which is panel C, they have long-lasting and asymmetric effects on the right tail of the distribution. And so here we have our quantile regression coefficients, and normally when we do inference on whether these effects are different, you would do inference on the 95th percentile coefficient and maybe subtract it from the median. But the benefit of the location scale model is that you can directly do inference on the location and on the scale parameter without having to pick a particular quantile or a particular percentile. This is exactly what we do in the table that's shown here. So we see, OK, what are the location and scale effects that are directly linked to the quantile regression coefficients that I showed? And so what we can see is that the scale parameter on the financial conditions index remains positive is positive and significant at a 3-year horizon. And in particular, initial debt really matters in terms of how it asymmetrically affects upside debt risks. So it remains significant up to a 5-year forecast horizon, as you can see. OK, so now let's bring it all together, right? So we did all of these steps. We combined the distributions. We aggregated to the global level. What does it mean for global debt at risk? I already mentioned this in my introduction. So the figure here plots the distribution of the predicted debt to GDP in 2027, which is, again, 3 years ahead. And we find that global debt at risk is estimated around 117% of GDP, which is 20 percentage points higher than projections. And beyond just the quantification, you can see that it's skewed to the right because the 5th percentile dot is higher than the 95th percentile dot. OK. And now, because we have these weights that we use to combine the various quantiles, we can actually just do a decomposition to figure out which of the predictive factors are driving debt risks. And this is kind of purely this mechanical exercise, which is nonetheless informative. So we find that primary deficits, again, this is at the global level, and tight financial conditions are the main factors contributing to upside risks to global debt. So primary deficits may be not that surprising, but really the non-economic factors have significant weight in the combined distribution. I think this is the point I wanted to make with this slide, that really ignoring the non-economic factors might be understating the level of debt risks or understating the drivers that could affect all the economic drivers of the shocks more fundamentally. And we can also look at variation over time. So here we're just plot the level of debt to GDP on the left, which is the black line, and the dotted red line is the debt at risk. So you can see it's been steadily increasing in line with global debt levels. But if you decompose this, or if you represent this differently by showing the upside and downside risks, where the upside risks are the difference between the 95th percentile and the median, and the downside risk is just the median and the 5th percentile, you can see that upside risks are consistently higher than downside risks, showing the asymmetric, showing the right skew. And then they're also a bit more volatile, and we'll see this more clearly when we look at a specific country example. And as I had mentioned earlier, there's also differences between income groups. So in advanced economies, debt at risk, and I don't show the time series, but we find that it has eased since the pandemic and is now around 131% of GDP. And in emerging market and developing economies, it's kind of risen and is around 96% of GDP. And the drivers, so the plot of drivers that I showed you at the global level, we find that the dominant drivers differ as well. So financial conditions play a larger role in advanced economies. So if you look at the yellow bar on financial conditions, it's much taller than, whereas in emerging markets, primary balance and political and economic uncertainty play a bigger role. Okay. So we've done the exercise, we've quantified debt risks, we've looked at the drivers. Is there any additional value to this measure beyond the quantification of debt risks? So there are 4 extensions we consider in the paper, and this is the first of them. We look at whether our debt at risk measure is particularly informative in predicting future fiscal crises. So to do this, we asked 2 questions, which is, do the debt at risk measures help predict fiscal crises? So are they important? And how important are they relative to other variables? So to do this, we construct a binary fiscal crisis variable that tells you whether a fiscal crisis is going to happen in a country in the next year or the next 2 years. And then we look at several econometric techniques to test this relationship. So let me start with the simplest one, right? So the first thing that we do is we just look at how do the debt at risk measures help predict fiscal crisis in a very simple logistic regression. So here you're just checking the correlation of the debt at risk against, or the probability of a fiscal crisis against debt at risk, conditional on all of these conditioning variables, as well as for the combined distribution, which I don't show here. And we find that there is a significant and positive relationship. So across all models, a 1 percentage point of GDP increase in the difference between the 95th and the 50th percentile is associated with around an 8 to 11 percentage point increase in the probability of a fiscal crisis. OK, so there's something going on. Let's investigate this further. So the next question we ask is, how well do these measures perform relative to other economic variables? So what we do here is, I would say we do 2 exercises. One is a Bayesian model averaging, or BMA analysis, where we look at how robust is this relationship between debt at risk and fiscal crisis. And what a BMA does is it calculates a posterior inclusion probability, which is the probability that debt at risk should be included in the true model of a fiscal crisis. And we find that if you look at the in-sample prediction or the out-of-sample prediction of debt at risk, it should always, and 1 means 100% probability, it should always be included in any model that estimates a fiscal crisis. But of course, I've said nothing about how important debt at risk is relative to other variables that have been predicted. So other variables could also have a posterior inclusion probability of 100%. So to kind of put a bow on this part of the extension, what we do is we say, how well do these measures perform relative to other economic variables? So we estimate a random forest, where on the left-hand side, the variable we're trying to predict is, again, this fiscal crisis. And here I'm showing you the grouped variable importances on all of the variables. And you can see that debt at risk has the highest variable importance when you include the difference between the 95th and the median as our measure of debt at risk. Much more so than the level of public debt and then other variables people have used in the literature. And then we also wanted to see, well, OK, we don't have this data for a lot of countries. We don't have financial data. We don't have policy uncertainty data for a lot of countries. So can we do this? Can we just apply this approach to other countries? And the benefit of doing these quantile coefficients 1 by 1 is you can almost for any country that has some available data, or there's available data for a subset of it, you can still construct debt at risk for that country. So using that kind of approach, we construct a measure based on more widely available just economic variables, and we are able to extend this for 175 countries, including many low-income countries for whom debt risks are important but haven't really been quantified in the literature. So here's just an example for a selected highly indebted low-income country. And then moving beyond the breadth, so moving beyond the increasing coverage along the breadth side, let's think about the length. So can we do a higher frequency debt at risk measure? And of course, we're able to do it in the same, using the same approach. So our third extension considers this higher frequency country-specific measure of debt at risk. So there are some advantages to this approach. So obviously, if you're doing this at a country level, you don't have the same issues as a panel. But you can also incorporate additional conditioning variables that are specific to that country. So we do this for the US, and of course, because it's the US, we have additional variables like the VIX or the EU's composite indicator of sovereign stress, which is available for many advanced economies. And we can just incorporate all of them without oversaturating the model, because again, the weights will penalize you if you don't fit the distribution very well. And the other benefit of using or doing this high frequency is you can allow these weights to vary over time. So before, these weights were, because we only had 24 years of data, you couldn't allow the weights that are used to combine distributions to vary over time. Now you can do it. And in panel A, we plot these time-varying weights for the US distribution. And what's really interesting is it kind of follows intuition. So the financial stress index, which is kind of the maroon color, its weight rises around the GFC, and then more recently, you can see that it's really uncertainty that's driving the debt dynamics or the predicted debt distribution for the US, consistent with what you might expect. And then you can plot these upside and downside risks for any country, again at a quarterly frequency, and you find the same pattern as you did for the globe, but with more volatility. So upside risks generally higher than downside risks, dotted red line above dotted green line. But the movements in the upside risks are much more volatile relative to the movements in the downside risks, highlighting the asymmetric results I mentioned earlier. And then I'm not going to spend too much time on this, but obviously, as you go more high frequency, and for major economies like the US, you can also check whether this debt at risk measure is, you can validate this debt at risk measure measure of uncertainty based on debt at risk against other measures of uncertainty in the literature. And we do this, so our measure of debt at risk based uncertainty is just the difference between the 95th and the 5th percentile. And again, that's invariant to our choice of distribution used to fit the model. And we find that it's pretty highly correlated with some of the major policy uncertainty indices that are used in the literature. Even though this measure is at most quarterly, whereas some of these measures are monthly. OK. I think perfect. I have a minute left, so let me conclude. So what do we do in this paper? We find that debt risks are elevated across the globe, and they're tilted to the upside. In other words, their upside risks are much higher and more volatile than downside risks. Global, just bringing it all together, global debt at risk in 2027 is around 117% of GDP with significant heterogeneity across many countries. And then we find that debt at risk is a robust, and in fact, the most robust predictor of oncoming fiscal crises, which are, of course, associated with all sorts of negative macroeconomic consequences. So Stephen already brought this up a little bit in his talk. It's like, what can policymakers do with this measure, and how do they interact with at-risk measures? How do they use these at-risk measures? So I would say the first and most obvious takeaway is that policymakers can use these measures to just quantify the size of debt risks in a severely adverse scenario, but do it in a way that goes beyond just a country-specific debt sustainability analysis. So you can really compare risks across countries. You can see how risks have evolved over time, because all the across the full panel, you've estimated debt risks for all countries and at all time periods, right? So you can really see how it's evolved. And then debt at risk could also be used as an early warning tool to monitor fiscal crises. And then beyond this, you can also use it for scenario analysis. So you can say, if just making this up, oil prices rise a certain amount, and that has an impact on inflation, and that has an impact on growth. How does that affect debt at risk? So how does the 95th percentile go up? Another way to think about it is if a country has big debt revisions, which we've seen in some emerging markets, what does that mean? Where does that land on the predicted distribution ex ante? And so it can really, it can help think about that as well. So I think I'm just good on time. Thank you for your attention. Look forward to the discussion. Thank you.
Faizaan. Thanks a lot. Max Schröder, the discussant. You have 10 minutes.
Yeah, thank you.
The floor is yours. Thank you.
Thank you. First of all, thank you for Faizaan for the very excellent presentation. I think it was a really great representation of the paper. It makes my job a lot easier. And luckily, as a discussant, I don't have to face any AI questions. So that's also quite a benefit. So just to start off, yeah, I'm discussing the paper, and given my role, the usual disclaimer applies. And then if we, perfect. So I always, given that it's kind of literature I feel at home in, so to say, I always find it particularly valuable if papers take these insights, take ideas from the growth at risk literature and apply it to other fields. And this is exactly what this paper is doing here in the context of fiscal policy. So that's already a big plus point from my side, so to say. And overall, I think the presentation showed that very well. It's a very timely and policy-relevant contribution. We've seen the motivational chart. Debt levels are rising. It's definitely a pressing issue, also currently in the US for many reasons. And here it introduces a very useful object, debt at risk. And my understanding of it, or how I view it after reviewing the paper, so to say, it's a bit like an FCI for fiscal sustainability. So this is my reading, and we're going to see where that comes from in a second as well. And in general, I mean, we've seen tons of empirical applications. There was a lot going on, different exercises, many countries. So here there's a really strong empirical and policy focus. So that's already in the paper. So what I want to focus on, and here I don't want to restate what we've just seen, is more what's the core contribution in my view, and then there's just a couple of points that I want to tackle. For example, what's really driving asymmetry in this case, because it's a very complicated pipeline of different layers, and I'm going to explain that in more detail. And then also, how should we finally interpret the results, which is a bit related to that as well. Now, so as I said before, the key contribution, in my opinion, is the object and not the machinery. So here it's really, of course, on the one hand, it takes its ideas, as I've said, from the growth and macroeconomics at risk literature, and views fiscal sustainability, so to say, as a distribution rather than a point forecast. So it takes on board these broader lessons, and then it focuses on tail risk. So it's a quantitative measure of fiscal vulnerabilities, one could say. So my overall takeaway, and if you want to take that away, let's say, home with you as well, it's a structured way to think about tail outcomes, and debt at risk is kind of a policy-relevant metric in that regard. Yeah, so my first key question, I try to phrase it as a question, maybe to also kick off discussion, is the paper extracting truly new information or effectively summarizing existing predictors? So here, basically, a lot of the inputs that we've seen are standard, like debt, growth, spreads, uncertainty, these types of things. Some may be a bit more non-standard, such as social unrest and these types of things. And we could, and then, of course, one could also use the same input in transformations directly in flexible models, such as the random forest or the logit, right? So what we've seen in the end, one could kind of just jump across or basically circumvent this entire procedure, just feed it into the logit regressions directly and kind of compare what does that yield in terms of forecast performance for fiscal crises. And then, of course, compare the performance. But I actually think even if, let's say, the initial predictors work already by themselves and don't need, let's say, this complicated machinery, there's a big advantage because debt at risk, in essence, as I've said, I view it a bit like an FCI for fiscal vulnerability. So instead of looking at all of these different indicators, one has one metric that can be shown, that can be represented, and that seems quite powerful. But nonetheless, I would think that doing that would clarify where the information comes from, kind of methods versus data, and also help position the framework a bit better within the broader literature. So my second question is a bit on this parallel versus joint estimation. So we've seen that all of these predictors are estimated separately and then combined ex post, and rather than estimated together in like a multivariate regression. So basically here, just to remind you, it was the current setup is there's separate models for each predictor. These are then combined ex post by weighting these densities. And the motivation, in essence, correct me if I'm wrong, was data availability, short samples across different countries, and so on and so forth. In general, however, I think would be nice if that could be at least discussed a bit more, because I mean, standard approaches do exist for unbalanced panels, for regularization, imputations, all of these things, and at the same time, then we would have a more joint interaction of these variables, much as we would with multivariate regression, which are currently not directly modeled. Instead, they're kind of replaced by this complicated weighting scheme, which makes it a bit harder to interpret how all of these variables actually interact. Then my third key question, I think that's kind of the more interesting one, at least for me. What is actually driving asymmetry in the depth distribution? So just to remind you, the baseline setup is this location scale model. So in essence, how it works is, and my intuitive understanding is a bit different, but then again, more than happy to be corrected, is that in essence, all of the asymmetry comes from the residual distribution. What the predictors now do is they shift the location, and they kind of squeeze or extend kind of this asymmetry across the support. So compared to a classical quantile model, it's not that, let's say, the predictors actually affect the quantile level and kind of change the shape of the distribution this way, but here it's more like they squeeze or extend the spread of the distribution, kind of just spreading out that asymmetry that is already in the distribution, in the residual distribution in the first place. So that's, I think, an interesting nuance. Which again is very different from what the literature would usually do. And then basically you have this kind of non-standard or non-parametric measure of the distribution. And what the paper then does is it puts a skew-t distribution on top again, kind of imposing a parametric form. And there's just a personal comment. In a way, you could estimate that directly as well. Now, if you were interested in the skew-t, or I mean, you already have this very non-parametric residual distribution, why not just drop the skew-t smoothing, so to say? And then finally, asymmetry is again reintroduced. So we've just taken it out. We kind of took an ion, we made it skew-t, and now we aggregate these distributions, weigh them, and now we can get multimodality and asymmetry again. So just like a very complicated way of constructing this density, kind of layering it in a way across different methods. So this is just something I think that deserves a bit of clarification, and the paper would benefit from making more explicit how, let's say, asymmetry in the final distribution is actually related to the variables that enter it in the first place. And there is ways of analyzing that as well, but I'm not going to go into detail here. Then in this context, one could clarify also the relative rules of state dependence, distributional rescaling, and aggregation, which is just related to that. And basically just, again, to summarize the slide, in what way do economic predictors really affect the tails in this setup? Then my final remark, what kind of uncertainty is depth digress actually capturing? And here it's more of a philosophical question, perhaps. So if I personally break it down, one could kind of bucket, perhaps, depth dynamics into three underlying forces. So there's more like the largely fixed component, which is government budgets and everything that's basically decided by legislature, and this is just there, mostly for a couple of years, kind of ahead. Then we have this macro financial variation, which is somewhat predictable. So also refinancing costs and all of these things, which might affect debt levels. And then we have these rare event shocks, these crises and contingencies, which you also talk about in the paper, such as the pandemic and so on, which really, kind of relate to true uncertainty and might make debt levels explode, such as we've seen during the pandemic. And of course, what the framework primarily captures is a state-dependent variation. It's not going to capture these unforeseen shocks that are not in the data that they can't have seen, right? It's just going to capture the learned relationships, so what we would characterize at risk. And I think this is actually quite interesting, because I think it actually strengthens the narrative of the paper, thinking about it this way. Because, of course, large depth increases are often driven by discrete, hard-to-predict shocks. But given that the model doesn't capture them, what it captures is this baseline vulnerability. So it doesn't capture the far out here realizations, and the literature, of course, also doesn't, whether it's growth at risk or inflation at risk. But here we could kind of view this measure as a lower bound, or a measure of systemic tail risk excluding extreme shocks. And I think that would even strengthen the view of kind of interpreting it as an FCI for depth sustainability in a sense. That's basically already all I had to say. Overall, I think you've heard me say that many times now. It's a compelling way to think about fiscal vulnerability, especially also as a summary measure, a summary metric. But it could be further strengthened by just thinking about a couple of aspects. So for example, they're clarifying the incremental informational content, benchmarking the layered approach, because here also if you want to go a bit more into the direction of forecasting, some horse races with also other models, other approaches would be very nice, I think, to kind of also give some substance here. And then clarifying where asymmetry and uncertainty come from, and finally kind of perhaps refining a bit the interpretation of asymmetry and tail risks in the context of fiscal sustainability. But overall, I can just say it's a paper that definitely rewards a careful read, and there's a lot going on there, a lot of colorful charts. So yeah, can highly recommend it for your journey home, perhaps. Yeah. Thanks.
Thank you. Thank you, Max. A great presentation. Faizaan, if you want to reply to some of the points raised in the discussion before the question and answers.
Yeah, so thank you so much. We discussed a few of these before as well. I think I have a couple of things to say. So almost the throwaway point is that I do think of it as this kind of debt at risk as this kind of summary statistic. It captures all of these vulnerabilities. So in the variable importance, or even in the Bayesian model averaging exercise, we include all of the original predictors on their own as well. And so then it's really the importance relative to all the original predictors. So financial stress on its own is there, and then debt at risk conditional on financial stress is there too. And you know, what wins is the debt at risk. On your second point, I agree. I think we have to be a bit more careful in the paper around, there's a combination of this non-parametric, parametric approach. And I think at the bare minimum, we can be clearer on which part of the exercise happened at which stage, if that makes sense. So what I mean by that is the financial crisis exercise is based on, there's no aggregation at that level, there's no recentering at that level, there's no fitting to a t-distribution at that level, right? So it's almost like, yes, we don't have any of those further aggregation methodologies or combining methodologies just based on the primitive, the first stage quantile prediction. So and so for each exercise that we show, I think we could be clearer on what level of that chain are we on, or when we are using the metric of debt at risk. So, but beyond that, kind of thinking about how the asymmetry in the final distribution is linked to that underlying is a different question than what I just said. So we'll have to think about that. On your last point about unforeseen shocks, I think there's two ways I think about it. If you are to believe that the shocks in the future are similar to shocks in the past, just fundamentally in how they drive economic variables, then the predicted distribution does match. The predicted distribution will be informative for the adverse outcome from even future shocks. So to give a very concrete example, if there's a low-income country that has big debt revisions and that causes the debt to go up, what part of the distribution that was modeled ex ante did that, what probability would you assign to that before knowing the fact? And if it's 99.9%, then clearly your previous distribution is not very informative. But if it's around the 80th percent of the density, then you're like, okay, this is somewhat informative. So we have found when we've done this type of backtesting in advanced and emerging markets that the ex ante distributions assign reasonable probabilities to extreme outcomes. So that's one. And then the second part of your to answer is yes, you could go a step further and say this is baseline. So I talked about it in my conclusion. You could do a scenario analysis and said, okay, well, this is based on data available, say, through the end of 2024. If the data was much worse, what would that do to these upside risks? And of course, the answer, because of the asymmetry, is it increases them further. So yeah, that's all I can say.
Great, cool. And as every presenter, you are going to get the AI question, please.
Q&A session. Okay. The question from the AI is, for the euro area, where sovereign risk interacts with banks, financial markets, and the common monetary policy, how could the debt at risk framework be extended to incorporate sovereign bank feedbacks or market-based indicators in a way that remains tractable and interpretable for monetary policy?
Cool.
Yeah. That's great.
Good question.
Yeah. In fact, we've gotten this question within the ECB, not from AI, so that's great.
It was in the training data.
It's in the training, sure, for sure.
So I think one of the advantages of the approach to kind of go one by one and then combine the distribution is you can include additional variables like we did for the US in one of our extensions without oversaturating the model. And we explain in the paper why that is. So beyond just the data availability point that we do make in the paper. So if there are certain variables that are really important for the euro area, for example, there are indicators of sovereign stress or financial market conditions that are not available for this broader sample of countries, but is available for the euro area. Exposure, central bank lending to the government, other measures of the sovereign bank nexus. We can just include them on the right-hand side, rerun the machinery, and see whether that meaningfully changes the distribution. But even before we check how it affects the distribution, we can just see what weights are on that variable when we do the out-of-sample fitting of the densities or combining of the densities. And so if it gets a weight just like the VIX did for the US or the financial stress index did for the US too earlier, then it shows that this is an informative measure for debt risks. Yeah.
Cool, great, thanks. Any questions from the floor? Otherwise, we go with another. Michele, please. We go with other AI questions, which, given that they are good.
Yeah.
Please. So I have a question on the choice of variables. So I noticed that you didn't put measures of private sector indebtedness on the right-hand side. Maybe that's because of data availability. But I was thinking that that would be very important, in particular in crisis, no? Because we know that there is this tendency for private debt to become public debt. So I just wanted to hear what's your thought about it.
We get another question just behind. Yeah.
Shall I just continue?
Go ahead.
Yeah, actually, just as a follow-up on Michele, I mean, one thing that came to my mind would be foreign debt, right? Isn't that you? My question is in this horse race, did you include just the linear model, including all your predictors, or did you that's included? Yes. I didn't see that. Okay. Yes. Thanks.
Okay. You want to reply to Michele?
So we did think about you already kind of alluded to it. Private sector indebtedness is important, but if it was just a data availability issue in that we don't really have consistent measures for all of the countries in the sample. This is also true for other variables like ratings changes and so on. We would need it. Yields are kind of the most commonly available variable, so you can compute spreads using them. So there are proxies, but you can always, if you're interested in a subset of countries where that data is available and you want to even go quarterly, then you're not constrained as much. I would agree it's an important feature. And this is the same reason, say, foreign debt, I think, matters differently for emerging markets and advanced economies. So if we want to include the currency composition of debt, which data availability is not bad on that front, but then are we comparing apples and oranges by including emerging markets and advanced economies in the same specification when we do that? Yes, we have fixed effects, but obviously those things do change across time, even within countries. So that was our initial, or even exchange rates are not in there for that reason. So yeah, that was our initial kind of exercise, was trying to estimate this kind of country consistent across time measure of global debt risk. But when you try and do it for subgroups, I think you have to include additional variables.
Okay, great. Any more questions? Yeah. John.
Thank you for the great talk. I kind of think that you mentioned that when you combine the densities, you might have multimodality, but you didn't explain anything about it afterwards, and I would like to know more about it. Does it have any interpretation? So are there things that you can say that we have two regimes and it could have a high risk because of this variable, and this is provoke the right mode, and the left mode is depending on another variable? Can we learn something about this?
So that's a good point. By just the very fact that you're combining densities, even if they're fitted to a skewed T distribution, so there's not a multimodal distribution behind it, but if you're combining multiple of these distributions, then yes, you are allowing for multimodality. I did not stress it too much. We do mention it as in the paper, but I didn't stress it too much because in the data, we don't see a lot of multimodality, so even at the country level. So I didn't want to, it's just the outcome, but it allows, there's that flexibility. So there's just not enough multimodality, which could be a product of the fact that there isn't fundamentally multimodality, or it's also because the underlying distribution is not multimodal. So if we allow for more flexibility in the distribution, maybe the combined distribution would have multimodality. But that I would have to check, yeah.
OK, great. I think 20 seconds, I would say. Let's make an applause for this great presentation by Faizaan.